Some say, though, that reading into the patterns that,
Yeah.
while, most of the economic data out there, the positive sentiment says that growth is on a good track, some say that the bond pattern suggesting otherwise, perhaps even a recession, Jim. What do you think?
Well, I think some of the signs that people traditionally look for, like the inverted yield curve, for example, we're close to that in the U.S., and that is often a precursor to a recession. It's wrong, though, to say that just because you see that, there is a recession coming. It doesn't look imminent, I think, from a lot of the data. That said, in late 2019, for example, there's been an enormous debt buildup. I think you've had fiscal policy quite easy in the U.S. That's pulled growth forward. And I think as that gets exhausted, coupled with the tightening, I think there's a fear growing that maybe 2018 could be the best of what we see in this cycle.
So almost that growth has got too good. I mean, clearly you believe in the US growth story. I mean, we've seen low unemployment, we have a strong dollar, inflation, of course, but of course that has a knock-on effect. There has to be an end to that goodness somewhere.
Yes, and when things are great, it's hard to get more great, right? And so I think that's what you're seeing is this expectation that you see in, maybe wage pressures start to come through as the Fed tightens. Remember, this is an experiment, right? QE was an experiment. The unwind of QE and tightening from a zero rate policy. This is all new, right? We haven't.
Are you
really
saying it's
tried
learning
this.
by doing, Jim?
I think so, and I think the market
Trial and error.
The market does look at that and say, I need to price in a risk that maybe the Fed moves a little bit too much. But look, what you're seeing is no real inflation fears over the long term bubble to the surface. And I think in many respects, that should be a good thing. If the Fed was tightening and still you saw inflation fears mounting, that to me would be a real worry and a cause for maybe overshoot.
But of course, other pointers to signs of a slowdown. There's noise out there that companies are slowing down investments. Is that something that you're seeing?
They are in some cases. I think investment overall has picked up, but it's quite narrow. So technology companies are perhaps investing more. The uncertainty around issues like trade are probably not helping. When you are faced with a lot of tariffs, for example, you don't know whether you should invest, but also for companies even in the US to invest in a big plant, knowing that those tariffs might in a few years not even be there.
And those tariffs that started out as perhaps just a few tariffs on foreign products look like to balloon into multiple tariffs across the board, which could actually damage the economy.
It could, and I think it's officially a trade war. I think we can call it that now. It was maybe a scuffle before, now it's a war. And you can tell because Trump is clearly, I think, against globalization. It's a theme that he doesn't buy into. But also, when he employs tariffs, what you're seeing is that other countries have to retaliate. And I think they feel like they must do that simply because if they don't stand up, Trump's just likely to ask for more. I think that's his style.
It's protectionism at its best.
It is protectionism,
right now.
And so thus far you'd look at the direct economic impacts of the tariffs, and it's not that large. It's maybe 0.2% on GDP globally, probably 0.5% maybe in China. It's not bad yet.
But it's the potential.
It's the potential, right? And if you see auto tariffs, for example, in Europe, if you really see the $200 billion that he's talked about for China come to fruition, that's probably the point at which you worry a lot about escalation. The uncertainty would probably cause investment to slow. And
this shift in policy, do you believe it's having an impact on the Fed yet in terms of interest rate increases? Could we see a slowdown there now?
I don't think so yet. I feel like they see an economy that's really firing on all cylinders, and they'll continue with this one tightening perhaps per quarter until they see that change. They too have the data that tells them that probably the tariffs are not that big of an impact yet, particularly on the U.S. economy, by the way. For the U.S., it's probably lower impact than it would be elsewhere. And so I don't think it will dissuade the Fed from moving just yet.
Now, in the financial industry, we often talk about the hunt for growth.
Yes.
Could we say that we're in this huge shift away from what was pretty cool, emerging markets and European equities. I mean, we've seen a run out, people are running away from those markets most exposed potentially to trade war. And we're actually seeing them go to, say, safer havens, which could be the US.
Ironically, I think it is. For all the talk that's, look, I think there are nothing but losers in a trade war. And the US, however, does lose less than anybody else, certainly loses a lot less than, say, an emerging market economy would. And I think you're seeing that relative shift. But in the meantime, all else is good. So trade might be detracting. Most other things are adding. So the overall growth story is still quite robust, I think, globally.
And in terms of, talking about the bond market in the US, what is the sort of 10-year treasury that we sort of use that, don't we, as a sort of benchmark and indicator? What can you tell us about that? Is that something that we should be, deciding our investments on?
Well, I think what you've seen is despite the steady increases in short-term rates, you're not seeing the same really flow through to the 10-year. And in fact, if you look at where rates have been driven higher this year, the central bank policy explains most of what you've seen. Inflation fears really haven't gotten out of control. There's nothing to suggest that there isn't a lot of demand globally for 10-year treasuries around the 3% mark. And the one time, I think earlier this year when you got above that, it didn't last for long, right? You saw the flows come in globally. There's enough need, I think, for protection, and there's enough search for yield that the US Treasury at 3% is meaningfully above a lot of other markets, and so it starts to attract those flows. And the world is still awash in a lot of excess savings, and so it's flowing to the highest yielding market. You don't have to maybe reach so far for yield anymore. You're getting it in safe instruments like treasuries.
And what about Europe? The European Central Bank, it seemed like it was buying everything at one point. Now it's stopping. What does that mean for the individual investor?
Well, I think they ran out of things to buy, first of all, so they have to stop. And
there's something left on the stall for the rest.
Yeah, so the QE unwind, I think, is probably, certainly in part due to the shortage of German bonds, for example. That said, I doubt they're going to pull away from, say, corporate markets. I think it still means that despite the QE unwind, rates aren't going up anytime soon, right? They've publicly stated that despite the unwind, it's 2019 before they even consider it. But even then, we're talking negative rates. I think the search for yield is still alive and well, and I don't see anything that the ECB has done that will really, I think, change that behavior.
In terms of the individual portfolio, it's as important as ever to have bonds in the portfolio as diversification, balancing it out.
I agree, and I've heard quite often that with low rates, you're not going to get the returns that you did in the past. And what I would say is, yes, that's absolutely true. You will not get the types of returns you've had from bonds over the last decade or so. But you may not get great returns from equities. And the diversification that you need, I think, does mean that modest appreciation is better than losing. And for me, when you're looking at a diversified portfolio, bonds do make sense. And so I don't really see that changing at all.
Just a quick word on China. We've heard, obviously, a slowdown in China. Is that a game changer or rather expected in your view?
I think it's still expected. Growth is still robust. I think the attempt that China's they're trying to delever. There's too much leverage in the economy. How do you do that and keep growth strong at the same time is hard. Throw trade wars on top of that, it's a real challenge, I think. And for me, it's
switching back to savings mode is not so easy, I guess.
Right, and so I think they're loosening up a little bit. I think they see the fears emerging around trade. You've seen equities, have a meaningful correction, and so I think that will prompt them to probably take it a little bit slower and probably not delever as quickly. And I'd look for a little bit of stimulus in areas that tries to get the economy going again. They cannot afford, with the amount of leverage they have, any meaningful slowdown. And so I think you'll see a little bit of pullback from that, which should be good. It's a key risk, though, I think, for the second half of this year is can they control the slowdown and not make a policy mistake. And I think that's true for a lot of central banks, right? Let's not make a policy mistake has got to be their mantra.
And we've just seen Putin and US President Donald Trump meeting today. Yeah. Do you expect any sort of comeback from that going forward?
Yeah, so I haven't seen all the comments that he's made about Putin or with Putin today.
Wants to be a greater friend with Russia, but not so much with Europe, by the sounds of it.
And I know he pointed to many foes, of which Russia was also on that list. So I think he views a tighter relationship with Russia as something that probably would be good. I actually believe he feels that about Europe too. And when I think Donald Trump says foe, I truly think he's meaning competitor. And for him, everyone as a trade competitor is somewhat of an enemy. I wouldn't read much more into it than that.
Lovely, Jim. Thank you very much for joining me.
Thank you.